Now, since they can print money to infinity, once that momentum starts on the downside, they'll pound it. They'll come in and start selling, knowing that that momentum has changed in their favor. Well, I've had a couple of interviews since, the breakout, and, the breakout, by the way I analyze the market, certainly has taken place. We broke out from the overhead resistance level of roughly 35 in US dollars. And we got above that 3 days in a row on above average volume, and it's continued to climb, and it's backed off a couple of days here and there. The back offs have been very slight, pennies versus dollars. So the breakout, as far as I'm concerned, is there. And yet, even with my Morgan rule that I just outlined, it's 80% accurate. So it's not 100%. So is it possible that, silver gets under 30 again? Yeah, but the probability is very, very low. So the big question, I think, now is where do we go from here? But before I answer that, I'd like to just mention that, price is what everybody looks at, and there's lots of ways to analyze markets from a technical perspective. I've learned probably all of them and forgotten probably more than half of them. But point and figure charts are one of the best. No one even knows what those are anymore. But silver's broken out from that basis, which is a very strong indicator for someone that's really technical or old school. And the other one is momentum. And I have a friend that does momentum analysis, and he's very, very good. And momentum in engineering is mass times velocity. So if you have a great big ship, that's a lot of mass. And velocity, it could be going any speed, but if you got a lot of mass and it's going at 10 knots, it's going to take a long time to turn that ship around. Whereas if you got a speedboat that has small mass, it'd be very easy to turn it around. So the point I'm making is that on a momentum basis, we have gotten a breakout, and that's more important than a price breakout. So I wanted to point that out, and I'll get you his name here in a moment. Michael Oliver. Sorry, it's Michael Oliver is his name. So I want to shout him out. It may have been that fast. I know you're right in the ballpark. I mean, I have to look at a chart to verify you, but yeah, so there's a lot going on. So we've got momentum, we've got price, we've got interest, we've got all kinds of chatter on Twitter. All the silver guys have come out and started talking. A lot of them are giving these real wild projections. I'm a little more conservative than that, but I think we're on our way. What's the gold silver ratio going to end up at the top? That remains to be determined. But I think there's a lot to consider here with what's going on. Yeah, I mean, the situation is rather bizarre. The wholesalers are just inundated with inventory. In fact, you could go to a friend of mine's website and you could buy constitutional silver, known as junk silver, in the trade for 70 cents under spot. That's the price you could buy it for as a retail investor. The wholesalers are doing whatever they can to try to offload inventory because they've got to make a two-way market. And so if someone sells, make up a big number, $10 million worth of silver, some of these wholesalers don't have that much ready cash, but they have credit lines. So they borrow the $10 million, they buy back the silver, and now they've got, 4% interest rate. So not only they buy it back at maybe a discount to spot, or maybe at spot, but now the clock is ticking because as like a car dealer, the longer that car's on the lot, the longer those bags of silver or silver bars or silver coins are sitting on the shelf, the more they've got to pay an interest cost to hold them. So they want to get rid of that inventory. And the retail market's dead. I mean, dead's probably not too strong a word. And yet we see the price going up and up and up. And that's to prove really that it's the derivatives market that we're watching. We're watching what the price of a paper contract is in silver or gold or platinum for that matter. And there's a huge push that is really killing the shorts. I mean, a lot of this rally has been short covering. And so, where's this going to end up? And, I know how it ended in 2011. I mean, I'll tell you ahead of time. Basically what happens is the smart money, if you want to call them that, And the bullion banks, the commercials, the people that really know how these markets operate because they are operators of these markets, they will get to a point where they're caught short. And it happens very rarely. What they'll do is they will step aside and they will not basically put on any contracts. I'm using a broad brush here. It's not exactly this, but it makes the thought process more clear. So they step aside and don't do any shorting. And so now the market's driven by the funds and the retail market. So now it'll exhaust without them in participation of it. So now the price goes higher and higher and higher, but there is no retail buying, but there's some, but very little. But the the trading funds may be buying, but eventually it'll exhaust. So they wait for it to exhaust, and then it'll start to come down. Now, since they can print money to infinity, once that momentum starts on the downside, they'll pound it. They'll come in and start selling like crazy, knowing that that momentum has changed in their favor, and then they'll start to really. So now what happens is the funds will have to start exiting, probably at a profit. Let's say they're long at 35 and price goes all the way to 42 and then it exhausts. Then at 42, the banks know, okay, now we've got momentum has changed. We could start shorting. So short at 42, it goes down to 41. Short more at 41. The bank was in at 35 and now it's at 41. So let's take a profit here, which is more selling. Selling on top of selling. The banks are shorting and the funds are long and they're selling to get a profit. Those trades have to match. If somebody wants to buy it at 41, there aren't many people. In fact, there are none. No one wants to buy it at 41 on the way down. They'd love to buy it at 41 on the way up. So now what happens? The next match is $38 the ounce. I'm exaggerating for effect. So that's where you get the gap in the chart. So no one wanted to buy it at 41, but a lot of people wanted to sell it at 41, but they don't match. So now the next match is at 38. Again, I'm doing it for exaggeration, but that's why you get a gap in a chart. Happens in corn, happens in wheat, soybean oil, cotton, cocoa, doesn't matter. It happens in the commodities markets. But this is what drives me nuts as far as the futures markets, and I'm not against them. I'm just against them being used in the manners that they've been used. And it's not just in silver, although silver's the stellar example. I mean, there's more, paper shorts in silver versus the actual reality of the physical market than any other commodity by far. In fact, it's in the metals by far. But nonetheless, I'm not predicting, big sell